Most people imagine that major financial events arrive with noise, press conferences, emergency meetings, breaking news banners, but in reality, the most important movements of money usually happen in silence. Capital, especially at the highest level, does not behave like public opinion. It does not argue, it does not explain itself, and it almost never asks for permission. When trillions of dollars move, they rarely do so in a single dramatic moment. They shift gradually through quiet reallocations, rebalance portfolios, revised assumptions, and long-term positioning decisions that appear ordinary when viewed in isolation. Nothing looks urgent, nothing feels dramatic, and that is precisely the point. For institutions managing enormous pools of capital, visibility is risk, silence is safety. History shows this pattern again and again. Before currencies weaken, before trade routes change, before political language catches up, money adjusts first. Not emotionally, not ideologically, but structurally. Capital moves toward environments that appear durable over decades, not impressive in headlines. This is why watching financial behavior tells a different story than watching the news. Publicly, the global narrative has been one of rivalry, tension, and separation. Political language has emphasized distance. Economic speeches have highlighted risk. Headlines have focused on conflict and uncertainty. Privately, however, capital has been doing something else, not rushing, not fleeing, but repositioning. This repositioning does not require belief in a country, a government, or a promise. Capital does not trust in the human sense. It evaluates systems, their depth, their rules, their ability to absorb scale, and their likelihood of existing in recognizable form many years from now. And when capital senses that a system is becoming unavoidable, it does not wait for public consensus. It simply begins to enter, slowly enough that the movement itself does not become the story. What makes this kind of shift difficult to notice is its calmness. There is no signal flare, no official announcement that something important has changed. Instead, there are subtle adjustments. Indexes quietly expand. Access channels open incrementally. Allocations move from optional to necessary. To an outsider, nothing appears to be happening. To capital, everything is being recalibrated. This is where most observers misunderstand power in finance. They assume money reacts to events. In reality, money often moves in anticipation of conditions that are not yet visible. It responds to long-term constraints, demographic gravity, institutional momentum, and structural design. When those conditions begin to align, silence becomes intentional. Large institutions do not want attention when they reposition. Attention invites imitation, scrutiny, and interference. Moving quietly allows flexibility. It allows adjustment. It allows exit if assumptions change. So when movement remains quiet for years, it suggests confidence rather than hesitation. This does not mean the system being entered is perfect. Capital does not require perfection. It requires continuity, predictable rules, enough scale to absorb large positions without distortion, and a framework that appears likely to endure pressure rather than fracture under it. What begins to emerge when viewed from this angle is a simple but unsettling realization. Public narratives and private positioning often diverge for long periods of time. By the time they realign, the financial landscape has already changed. And this is why the most important question is not what headlines are saying, but what capital is doing while no one is watching. Because when money moves quietly, it is rarely experimenting. It is adjusting to something it already believes is unfolding. This understanding sets the stage for a deeper question, not about the movement itself, but about the kinds of institutions capable of acting this patiently, this silently, and at this scale. When people hear the names BlackRock, JP Morgan, or the largest U.S. banks, they often imagine companies in the ordinary sense, offices, executives, quarterly earnings, but at their true scale, these institutions function less like businesses and more like financial infrastructure. They do not chase opportunity the way smaller players do. They design exposure. Every decision they make is filtered through time horizons that stretch far beyond a news cycle, a political term, or even a decade. Their role is not to be early to trends that can reverse quickly, but to be positioned correctly when structural realities settle into place. This is why their movements are rarely sudden and never accidental. When institutions of this size adjust direction, the process usually begins years earlier inside models, scenario analyses, and quiet internal debates about how the global system is evolving. These are not conversations about optimism or fear. They are conversations about probability. How stable is a system likely to be under stress? Can it absorb capital at scale without distortion? Will access expand or contract over time? And most importantly, will this system still exist in a recognizable form many years from now? For firms managing trillions, being wrong is not a temporary loss. It is a systemic failure. So caution is built directly into the decision-making process. Exposure is layered, entry is gradual. Optionality is preserved for as long as possible. This is why, when these institutions begin increasing allocation toward a particular system, it does not reflect enthusiasm. It reflects acceptance. Acceptance that certain markets can no longer be ignored without creating risk of a different kind, the risk of absence. In the case of China, this realization did not arrive suddenly. It emerged slowly as global supply chains deepened, as domestic markets expanded, and as financial infrastructure matured. Over time, not being present began to look less like prudence and more like imbalance. What makes this shift difficult to interpret is that it does not require public endorsement. These institutions are not expressing confidence in a political system or making statements about alignment. They are responding to scale. Scale changes behavior. When an economy reaches a certain size, its financial system becomes unavoidable for global capital, not because it is admired, but because exclusion itself becomes a distortion. This is where many observers misread intention. They assume participation implies agreement. In reality, participation often signals inevitability. For large financial institutions, the question is rarely whether to engage, but how. Through what channels, under what constraints, with how much exposure, and with what ability to adjust if conditions change. Everything is calibrated, nothing is rushed, and crucially, nothing is framed as a bet. This is also why these movements rarely happen in isolation. BlackRock does not move alone. Major banks do not reposition independently. Their actions echo across index providers, custodians, asset managers, and regulatory frameworks, creating a coordinated shift that appears organic rather than orchestrated. From the outside, it looks like coincidence. From the inside, it looks like alignment. By the time capital reaches this level of consensus, the decision is no longer speculative. It is procedural. This understanding leads naturally to the next layer of the story, not about the institutions themselves, but about the system they were adjusting toward. What kind of financial environment grows slowly enough, absorbs quietly enough, and expands steadily enough to draw this level of patient capital? That question moves us beyond who acted and into why China's financial system, at this particular moment, became impossible to ignore. To understand why large institutions began adjusting toward China's financial system, it helps to let go of a familiar assumption that capital is drawn only to what looks free, open, or familiar. In practice, capital is drawn to what functions reliably under pressure. China's financial system was not designed to resemble Western markets. It developed under different constraints, different priorities, and a different relationship between the state and capital. This difference is often described as a weakness or a risk. But for long-term capital, difference itself can be informative. Rather than prioritizing speed, China's system emphasized control. Rather than celebrating constant innovation, it focused on continuity. Rather than allowing markets to expand freely and then correct violently, it attempted to shape growth within boundaries. This did not make the system efficient in the short term, but it made it legible over the long term. For institutions thinking in decades, legibility matters. A system does not need to be flexible if its direction is consistent. It does not need to be perfectly open if access expands predictably. What matters is whether the rules change abruptly or evolve gradually. Over time, China's financial structure began to show a particular kind of resilience. not the resilience of rapid recovery, but the resilience of containment. Stress was managed rather than released. Imbalances were addressed through adjustment rather than collapse. This approach created frustration for short-term investors, but it offered something different to patient capital, an environment where volatility was dampened and surprises were limited. Another important distinction lies in the relationship between finance and the real economy. In China, financial markets did not exist primarily as independent arenas of speculation. They were tied closely to industrial capacity, trade flows, and long-term national planning. For global institutions managing exposure across many regions, this linkage reduced a specific kind of risk, the risk of financial markets detaching completely from underlying economic activity. This does not imply safety. It implies structure, and structure is something capital understands. As China's domestic markets expanded, their depth increased. Liquidity improved. Infrastructure matured. Settlement systems, custody services, and regulatory frameworks slowly aligned with international standards, not all at once, but step by step. Each step reduced friction. Each reduction made participation easier to justify. Importantly, this evolution did not require optimism. It required observation. Institutions watched how the system responded to stress, how policy adjusted during slowdowns, and how priorities were maintained during uncertainty. What they saw was not perfection, but persistence. A system willing to trade speed for stability sends a different signal than one optimized for rapid growth. It suggests that survival, not applause, is the core objective. For capital that must endure across generations, that signal matters. This is where perspective quietly shifts for the listener. The question stops being whether China's financial system aligns with Western expectations. Instead, it becomes whether alignment is necessary at all. Capital does not ask for familiarity, it asks for durability. By the time large institutions increased exposure, they were not embracing a model. They were acknowledging that a parallel system had reached sufficient scale, coherence, and continuity to be included not as an experiment, but as part of the global financial landscape. And once that inclusion begins, even cautiously, it sets in motion a broader reconsideration not just of China's system, but of how global finance itself is slowly being rebalanced. For most of its modern history, China's financial system was not closed, but it was carefully gated. Access existed, yet it came with friction limits on ownership, restrictions on movement, and regulatory layers that made large-scale participation inconvenient rather than impossible. For a long time, that inconvenience served a purpose. It filtered capital by patience. Only institutions willing to accept gradual entry, long approval cycles, and evolving rules could participate meaningfully. Short-term capital stayed largely outside. Long-term capital learned how the system worked. Over time, those gates did not disappear, they widened. Access expanded not through dramatic liberalization, but through technical adjustments, quota systems that evolved, settlement processes that improved, and channels that allowed foreign capital to enter without overwhelming domestic stability. Each adjustment on its own seemed minor. Together, they changed the equation. As access improved, scale became unavoidable. China's bond and equity markets grew large enough that exclusion itself began to distort global portfolios. Index providers faced a simple dilemma: reflect reality or misrepresent it. Inclusion was not an endorsement, it was an acknowledgement. Once that acknowledgement occurred, capital followed not because it wanted to be bold, but because it needed to remain accurate. Passive flows moved first, active strategies followed cautiously. Exposure increased not in leaps, but in increments. Being early carried a cost, being absent carried a greater one. For large institutions, timing is less about speed and more about sequence. Enter too quickly, and you absorb volatility without influence. Enter too late, and you inherit constraints without flexibility. The quiet expansion of access allowed institutions to enter at a pace that preserved optionality. They could participate without committing fully, observe without declaring intent, adjust without drawing attention. This is why the movement appeared slow and why it appeared quiet. Scale also changes behavior within the system. As foreign participation increased, standards adapted. Transparency improved where it mattered most. Interfaces aligned, not because of external pressure, but because scale demanded compatibility. Large systems, once connected, reshape each other subtly. For institutions like BlackRock or JP Morgan, this mattered more than short-term returns. They were not positioning for a cycle. They were integrating a system. By the time capital flows reached into the trillions, the movement was no longer speculative. It was procedural. The question had shifted from "should we engage?" to "how do we manage exposure responsibly over time?" This is the point where patterns become visible, not dramatic patterns, but steady ones. Allocation increases follow structural changes. Regulatory openings align with index weightings. Quiet confidence replaces hesitation. And this prepares the mind for the final realization that this shift is not really about China alone. It is about a global financial system adjusting itself, slowly and calmly, to a world where scale, access, and endurance matter more than familiarity. That understanding leads naturally into the final chapter, where the focus moves away from where the money went, and toward what its movement quietly signals about the future shape of global finance. Long before public opinion shifts, before political language softens or hardens, and before official strategies are rewritten, capital tends to move, not loudly, not emotionally, but consistently. This has always been its nature. Throughout history, money has acted as an early signal, not because it predicts the future, but because it responds to constraints that most people do not see yet. Demographics, production capacity, institutional momentum, and structural endurance all register in capital markets long before they become part of everyday conversation. When capital reallocates quietly, it is not making a statement. It is adjusting its expectations. This is where many observers make a mistake. They look for intention where there is only adaptation. They search for allegiance where there is only alignment with reality as it appears from a long distance. Capital does not choose sides. It chooses continuity. In the case of the shift toward China's financial system, this continuity was not ideological. It was practical. A system of sufficient size, depth, and persistence had emerged. Ignoring it began to look less like caution and more like exposure to absence. This pattern has appeared before. Financial centers do not replace one another overnight. They overlap. They coexist. For long periods, money flows between old structures and new ones, not as a rejection of the past, but as preparation for a broader configuration. This overlap phase is often misunderstood because it lacks drama. There is no single turning point, no clear announcement that a new order has arrived. Instead, there is gradual redistribution, more pathways, more interconnection, more quiet redundancy built into the system. Capital behaves this way because it must. Large institutions cannot afford binary outcomes. They do not wait for certainty. They build resilience by spreading exposure across emerging realities while maintaining ties to established ones. This is not hedging in the traditional sense. It is recognition. Recognition that the world's economic weight is no longer concentrated in one direction. Recognition that production, consumption, and savings patterns have shifted over decades. Recognition that financial architecture must eventually reflect that shift, even if public narratives resist it. For the listener, this is where understanding deepens. The movement of $2 trillion stops feeling like a headline number and starts feeling like a signal, not of allegiance, but of adjustment. A signal that global finance is reorganizing itself quietly, without asking permission, and without waiting for consensus. This does not imply instability. It implies transition. Transitions are uncomfortable when viewed up close, but from a distance they often appear measured, deliberate, and slow. Capital prefers distance. It prefers time. It prefers adjustments that can be reversed, refined, or expanded as conditions evolve. And this is why the shift matters less as an isolated event and more as part of a longer pattern. Capital voting early does not decide outcomes. It simply reveals where pressure is accumulating. By the time that pressure becomes visible to everyone else, the adjustment is already well underway. This realization does not demand action from the viewer. It invites awareness, a quieter way of observing the world, not through statements and promises, but through the slow, deliberate movements that happen before words catch up. That awareness prepares the listener for the final section, where the story does not conclude with answers, but with a wider frame, one that keeps unfolding long after the audio fades. When people look back on major shifts in history, they often imagine moments of clarity, speeches, agreements, or visible turning points. But most structural changes do not arrive that way. They emerge gradually through a series of small adjustments that only appear meaningful in hindsight. The movement of capital toward China's financial system fits this pattern. There was no declaration that a new era had begun, no announcement that old systems were being replaced. Instead, there was quiet integration. Additional connections, expanded pathways, a growing sense that the global financial system was becoming more layered, more distributed, and less centered on a single axis. This is how large systems protect themselves. Rather than committing to one future, they prepare for several. Rather than abandoning what exists, they build alongside it. Over time, these parallel structures stop feeling alternative and begin to feel normal. For the listener, this is where the story subtly changes shape. What once seemed like a question about China becomes a question about the nature of global finance itself, about how power, risk, and stability are managed when no single system can carry the full weight alone. This rearrangement does not imply decline. It implies diffusion. Financial influence, like economic activity, spreads outward as scale increases. New centers do not eliminate old ones. They reduce dependence on them. And in doing so, they change how resilience is built into the system. What makes this process difficult to track is its lack of urgency. There is no countdown, no deadline, no final outcome waiting to be revealed. The system continues to function while it slowly reshapes itself underneath. That is why this shift feels unfinished, and why it likely always will. Capital does not seek resolution. It seeks adaptability. It leaves doors open, it keeps options alive, and it avoids conclusions whenever possible. For those paying close attention, this creates a different way of understanding the world, one that is less reactive, less emotional, and less dependent on official narratives. A way of observing patterns rather than events. The listener is not left with instructions, not with warnings, not with predictions, only with a clearer lens. A recognition that while public attention moves quickly from one topic to the next, deeper systems move slowly, deliberately, and often invisibly, and that by the time change feels obvious, it has usually been underway for a long time. The shift of trillions of dollars did not announce a new order. It did not close a chapter. It simply revealed that the pages are still turning, and perhaps the most important takeaway is not where the money went, but how it moved calmly, quietly, and without needing to explain itself. That understanding lingers, not as urgency, but as awareness, a sense that the world is not breaking apart, nor snapping into place, but gently rearranging itself one silent adjustment at a time.